Hi folks! So we just covered our first section where we talked a bunch about different types of valuation methods really briefly, and we talked about this general idea of how we're actually going to try and value a company using the discounted cash flow model. So now that we have a general high-level sense of what that means and how we do that, which we'll briefly cover before we jump into this today we're actually going to go through the exercise of trying to actually punch in numbers into the spreadsheet and actually get us an evaluation that comes out. So we're going to go ahead and do that by actually going through looking at one specific example, in this case Shopify. We're going to be looking at their 10K, in this case it's called the 40F because they're based in Canada, but basically it's the same thing. We're going to be looking at their annual report, punching in information into the spreadsheet to get a valuation back. So really quickly, some resources before we jump into it. Professor Damodaran actually has a really good video that from a couple years back that he did where he's doing exactly the same thing. We are basically going to be following this video today, except essentially just with an updated example. So I figured that getting more practice in actually, looking at a 10K, trying to actually parse out what you're trying to get out and actually go through this exercise is really helpful. So today we're going to be doing Shopify. I want to do more of these in the future just so I can get more practice myself with doing this. And, but yeah, I just wanted to point this out because if you have any questions, he goes into a bunch of this as well. So just hearing things over and over again, I think from different perspectives sometimes can be really helpful in helping things sink in. So feel free to check this out if you have any additional questions. And also I pointed this out in the description of my last video, but if you want some more, another take, right, on DCFs and what they mean, here's another resource that you can check out. I've read some of Lynn's stuff, and for the most part it's pretty good, and so feel free to read this if you have additional questions and need some more sort of just reiterations of what a DCF is and what we're trying to do here. So before we jump into it, I want to just recatch us up just so that we're kind of all have it all fresh in our minds. The general idea of a discounted cash flow valuation, right, as we've called out, is basically what you want to do is you want to estimate what your cash flows in the future for a particular company will be for the next year, 2 years, etc., etc. We're going to be doing up to 10 years. And after we do that, we'll also want to figure out how we actually are going to discount that back into the present so that we can get an accurate view of what we think X amount of cash flow in the future is worth today. So I just want to call out one last thing just to reiterate, because we'll try and the worksheet we'll be going off of is kind of organized in this way, but the general buckets of information we need to know are: one, historical data. So we need to know how has the company done in the past / like last year and this year, which we'll get off our 10K. And then outside of that, the two other major areas are: one, what are the future cash flows going to look like for the company, right? So we can calculate, okay, what are all these cash flows? That is dependent on us estimating out a revenue growth number and then also a margin number. And lastly, we also want to understand and try and figure out what our discount rate is. And so we'll also do that as well. So without further ado, let's get into it. So, okay, we're just going to start from the top. Well, actually, just to sort of sketch out like this spreadsheet and how it works. As I mentioned, right, we've got the three different areas that we want to understand, and that's sort of how this sheet is generally organized. So, at a high level, we'll be putting in most of our data into this input sheet here. So this is the spreadsheet where you will put in all of your variables, and you'll put in all your different assumptions and stuff like that. And after that, we've got a valuation output spreadsheet. So I'll click on this later, but basically that you don't need to put in anything into it. It just essentially takes all the input from this sheet here, and it processes it and then gives you a valuation given all the formulas that it runs. And then we've got a whole bunch of different worksheets to help us calculate like some of these interim numbers. So that's how this sheet is generally laid out. We'll go into the worksheet as we need to, as we are filling this out. But even on this sheet, this is basically organized in the three different buckets that I talked about earlier. So we've got our first bucket around what has happened in the past, right? So what is the current state of things? This is the second area, right, which is around what are the assumptions that we're making for revenue growth, for margins in the future, so that we can estimate out our future cash flows. And then this last area here is more so around figuring out what our discount rate is, which is basically, which I think essentially they use, the discount rate is effectively the cost of capital, which is what this rate is, which we'll use a calculator later to figure out. And then lastly, we've got a section here about just like general assorted things around shares, because the claims that people have on the equity might also impact the valuation price. So we'll have to put in that. And this last section here, it's basically very advanced options if you want to override some of the settings and assumptions that he makes. We're not going to go, we'll maybe talk about some of these later on. Another caveat I'll mention is that, as you can probably already get a sense of, there's a lot going on in the spreadsheet. And so I'm not going to necessarily go into everything today because I think that might be a bit overwhelming. We'll try and just go over some of the major high level items, and we'll double click on the things that we think we need to double click into. But otherwise, I think we'll just sort of start from the top. Okay, so starting from the top, the date of valuation we'll put in here. I did this last week, so that's what I put in here. This is helpful if you want to reference this in the future and you want a sense of when you actually did this. You want to put in the ticker for your particular company. In this case, I'm doing Shopify. I forget if I mentioned this last time, but Shopify is basically it's a Canadian company. They build software for online merchants in order to help them run their general operations to actually run a store. So that's what they do. And you also want to put in the date of the last 10K. That is so that we can kind of calculate some of these revenue numbers automatically. I got that by going to the Shopify investor relations site. And I saw that last year they filed their 40F. I forget if I mentioned this is basically the same thing as a 10K. Last February on the 12th. So that's what I put in here. So I put in that there. And okay, moving straight into it. So we're going to start with the country incorporation. This is kind of random. I don't think this actually really matters. I couldn't actually even figure out if they're incorporated in the US or in Canada. I'm going to assume it's Canada. So anyway, I put in that. And then we'll put in the industry. So in this case, as I mentioned, they build software. So that's what I put in here. This is helpful because we use this industry data to help us actually calculate out some of these automatic numbers. So it tells us there's resources other in the spreadsheet that list out what some of these numbers look like by industry. So by putting it here, we pull in the relevant industry data for all the other software companies out there. So we have that at the US level and then also at the global level. It's also a good time to point out the colors on this. So green basically means it's auto-calculated. You don't need to worry about it. And yellow is everything that you need to fill in. So, okay, we're going to start from the top, revenues. So I actually made a note of all the different pages that I found the information on, so that can make things easier. So we're going to jump straight to 103. So 103 is the profit loss income sheet. So we're going to first start out with revenues. That's easy. Some companies are really nice and they break out your revenue by different categories. So that helps us get a sense of how big each business is. In this case, we just want the total revenue. So that's what I grabbed here. This is a good time to make a note about units. So the main thing about units is that you just want to make sure you're consistent across both. Like it doesn't have to necessarily match because, for example, they mentioned here that all these numbers are expressed in thousands, right? Except for share and per share amounts. In my spreadsheet, I actually use it based off of millions because I didn't want to skip having to sort of input in all my numbers and put in extra numbers. So I abbreviate, or I did everything in millions instead of thousands. So as long as you're consistent, it's fine. I will say to make your life easier, if you don't want to think about it, you might just want to copy exactly what they have. So you don't have to think about converting it. But regardless, I put mine in millions. That's what we're going to go with. So, okay, we want the data from this year and last year. So this case, it was in this case, they read out 2.9 million times 1,000. So basically what I did is I just chopped off the last 3 digits and then I just put everything. I put everything else, or I moved the decimal three digits in. So in this case, it looks like they read out here 2.9 million. Basically when I convert it over, it's basically 2929.49. So that's what it looks like. And then last year it was basically $1.5 billion, and then I converted that into 1,578. Cool. Okay, so that's revenues. Next, we want operating income or EBIT. So that's this line item here. It's called income, sometimes loss from operations if that company has lost money and has negative operating income. So in this case, I see 90,000 and 153. I convert that over and I get 90.15. So that matches. And then last year, it looks like they had a negative operating income. So I convert negative 141,000 over to negative 141.14. So that looks good. So that's operating income. And then next we have interest expense. So looks like last year they didn't have any interest expense, so I left it blank. And then it looks like, actually, this should be negative. Oops, I made a mistake already. Okay, so interest expense last year was, oh, actually, no, maybe that, no, I think that's proper. Because I think in this case, I assume interest expense should be positive. Yeah. I'm not 100% sure actually now that I think about it. I'm going to assume it should be positive because I think this should be anyway, we'll just make a note of it and think about that. I think because in this case, it shows up as negative, right? Because it's an expense, it's some money that you're paying out. And in this case, okay, maybe just make it negative for now. And if it turns out really weird later, we'll know why. Okay, so we'll just make it consistent. So yeah, it converts over to negative 0.08. Book value of equity. This, I made a note, it's also called total shareholders equity. And I noted I found that on 102, which is the previous page. If we go and look at down here, total shareholders equity. So I get 6.4 million. I convert that over to 6,400. And last year it was just over 3 million, which I convert over to just over 3,000. Next, book value of debt. This one is a little bit more complicated because I believe a lot of these don't have an obvious thing that you can just grab. So Professor Damodaran has a note here for this. Okay. He says, enter the book value of interest-bearing debt, short and long-term, for your company from the latest balance sheet. Do not include accounts payable, supply credit, or other non-interest-bearing liabilities. So this is where it's not super simple. You kind of have to put a bit of your critical thinking hat on and actually look at some of these liabilities to figure out if they should be included or not. So we're looking at this, right? So it looks like he mentioned we're not including accounts payable. We're going to ignore that. Actually, for those that aren't familiar, liability, it's basically everything that a company owes. So they've got both short-term and long-term liabilities. So we're going to go through each line item to figure out, is this an interest-bearing debt or not? And if so, we'll include that. So he mentioned account payables. We don't pay interest on that. Income taxes payable, we also don't really pay interest on that. That's just taxes we have to pay. Deferred revenue, I actually don't know what this is, but I don't think we pay interest on it. So I'm going to ignore it for now. I'm going to look this up afterward. Hopefully I'll have a better answer for you next time. And so lease liabilities, that is something, so that, when you have a lease, right, that's basically the same as you have to pay rent to someone. So that means something you have to pay interest. Is that something you pay interest on? Now that I think about it, it sounds off. Anyway, for some reason, I know that you have to because I've checked the numbers and it is consistent. But basically, so we'll want to include lease liabilities here. We'll want to include both short and long-term lease liabilities. And then we'll also want to include our convertible senior notes, which is definitely debt. This is just like a standard bond that they're putting out. So what we'll do is we will sum up senior convertible notes, we'll sum up lease liabilities here, and we'll also sum up the short-term lease liabilities. So if we add that up, so 758 plus 144 plus 10 from the short term, which gives us 912. That is what I put in here, 912.88. And we'll want to do the same thing for last year. So last year we didn't have any convertible notes. And so we have long-term lease liabilities of 142 plus short-term lease liabilities of 9. Yeah, 9, which gives us 151, which is what I put in here. because this is not super straightforward, if you want to double check this, which I would definitely recommend, you can actually go, so this is my company sheet, and you can actually go and confirm. So I have a number here that tracks total debt. And so you can see last year, 912. So looks like that number was correct. And also the year before that was 151, which is also what I got. So just to sanity check yourself in case, you're not quite sure, that's what you can do. Okay, do you have R&D expenses to capitalize? This is starting to get into a little bit more complicated nature. So I believe the general idea around capitalizing R&D expenses is that what they're trying to say is right now, right, here I can try to illustrate this. So if we look at our operating expenses, right, so these three, right, R&D, everything that you incur for that year, you have to charge as an expense for that year. And I believe the general idea around capitalizing an R&D expense is that it allows you to treat, because especially for, I would say, like, I think a lot of software companies, right, where you have a lot of, you spend a lot of money on R&D, but they're not really an expense. It's more of an asset, right? Because you're actually like building like your asset from your R&D expenses. This basically allows you to somehow convert R&D, which would typically be an expense, to an asset. Anyway, a bit more complicated. I'm just going to assume no for now because that's a bit more complicated. And there's also another line item here around, do you have operating lease commitments? So in this case, I know that we do, but I believe, actually I was thinking about this because so he calls it out separately here because I believe Professor Damodaran mentioned that in previous years, leases were not necessarily included as part of your debt. And so he explicitly calls this out, I think in order to explicitly add it back in. It's a recent change, I believe, where I think more recently they have started including lease liabilities into expenses, but I think he still does it just by default because he isn't sure. Anyway, in this case, I think by default, because I think I just added it in debt, I think I can say no here. But I'll call out, like, in case you want to look at this and kind of decide for yourself. So he mentions that there is a lease worksheet. So he converts it to debt. So in this case, I don't think we need to add it because we already tracked it, I believe. But just to go through the exercise, what we'll want to do is, he has a separate sheet here called Operating Lease Converter. I make a note here that I saw operating lease information on 125. So we're going to jump to that page. Because, yeah, it will basically give you a very handy dandy breakdown of what your operating lease liabilities look like for the next couple of years. So if we go into this spreadsheet, this subsheet, it wants us to track what is the current operating expense for the latest year. I actually don't know if I have that here. Total lease expense. Okay, yeah. So last year, yeah, it looks like it was, so operating lease expense, we just want that one. So I got 20.48, which is what I got here. And then what you'll want to do is you'll type in your operating lease information for the next 5 years and then the year after. So that's what I did. I converted all these numbers over to this part here. And that looks wrong. Okay, good God. Anyway, so okay, you can do that if you want to capitalize those, which basically means you'll add that as an additional expense. You can say yes. In this case, since I think we're covered, I'm actually going to flip that and say no. Okay, moving on. Cash and marketable securities. So I said I found that back on 102. So we're going to go back. Okay, cash, and this is basically trying to gauge what is your current cash position. So sometimes this comes up as 2 line items, sometimes this is 1. So in this case, they've got cash. They've also got marketable securities, which is the separate line item. So we'll want to add those together and put that in. So I basically added 2.7 million plus 3.6 million. I somehow get 6.3 million here, which is I put in here. And then the same thing for the year before. So I'll add 1.8 million times 650,000, and I ultimately get $2.4 billion, or anyway, 22,455 listed here. Okay, so that sounds good. And then next we want, okay, so this is where things get a little bit interesting. This is where it's going to be very different depending on the company that you have and what, so these two sections, these two line items here are basically talking about if your company owns another part of another company. So I believe you would cross holdings and other non-operating assets. Actually, is there a note here? Okay. Okay, yeah. So enter the market value of these non-cash assets whose earnings are and will never show up as part of operating income. The most common ones are minority holdings in other companies. So, there's a note. So this is where I think you will have to just dig through the 10K to see if they talk about this. In this case, I found a mention of this on page 120. So investments, maybe you try and look up this word in the 10K. But so I read that and said, okay, the carrying amount of such investments as of the end of last year was $173 million, I guess, which is the actual amount, which is what I put in here. So basically, it says later, I guess, like, it looks like the majority of that stake is a stake in Affirm, which is another company that does like it's like around payments / like fintech stuff. So it looks like the majority of that stake is a stake in Affirm. And so anyway, I put in the top level number. I think they also call it that last year it was only 2.5 million. So that's what I put in here as well. And so generally speaking, this is a place for you to put, if your company owns a stake of another company, like what is that worth, so that you can include that in the valuation. Minority interest is sort of the flip side of this. So basically, just to summarize what he mentions in the note, it's so apparently if you own more than 50% of another company, you are, I guess, forced by accounting regulations to include the company that you own more than 50% of. You're required to add all of their financials and consolidate them onto your financials. But of course, if you only own, like, say 60% of the company and 40% is owned by other people, you need a way to actually take that off of your to call it the fact that you don't own the full percentage. I believe that they will put so the minority interest reflects the book value of the 40% of the equity that does not belong to you. So basically this is a place for you to write out, okay, like, this is where this other company owns 40% of the company, and this is where you would put it in, so we can subtract that out later. Maybe we'll come across an example in the future where we'll have to do this, but for now we're going to skip it because that's not, actually I made a note, 112. Does that say anything? Oh, okay. So the company has minority equity. Actually, no, this is basically the same thing. Another. Okay. I'm just going to skip this for now. I think we're probably okay. Am I getting these confused? I might be. Anyway. Actually, we'll confirm this later. We'll confirm this later to make sure this is being treated the right way when we get the final valuation. Anyway, okay, so that's that. And then lastly, we just need to know what is the latest number of shares outstanding. So you can get that from the finance. I believe it's listed here. Actually, yeah. So it looks like it's listed on page 75. So they list out how many shares that they had when this was issued. Of course, this is usually information that people have more publicly. And so I actually pulled this, I believe, just from Google Finance. So yeah, I put this here just so that I have it readily available so I can type it in. I believe, so you could actually probably just replace this and have it automatically fulfill in, but this is I will caveat this by saying this is a very finicky spreadsheet. And so I put in just this on the side, and so you can type it in. Oh, actually, so I can update this. 72.43. Guess it's gone down since then. But I put this in just to help me so I can type it in. But in general, I I'm going to manually put in a bunch of these numbers just so that everything kind of stays kosher. I tried to do the same thing to kind of shortcut having to pull the risk-free rate, and it just caused nightmares, especially with the risk-free rate, because that causes all kinds of weird stuff because there's a lot of dependencies in the sheet. Anyway, so we'll want to type that in. You want to get the latest numbers available here. So we did that. And then the effective tax rate versus the marginal rate. So I believe, so 135. Okay, so I believe I took the marginal tax rate from this rate here, which is, yeah, I believe the tax rate there. And then I believe for this 33% number, I actually tried to calculate that. So I believe what I did was I took 79, which is, I believe, the taxes that they paid, and I divided that over all of their like taxable income. So I basically did like 79 over 240, which gives me around 33%. Yeah. Anyway, okay, so that's the effective tax rate. So that looks good. So it looks like we're done with this top part. We're going to skip over the assumptions for now because we'll get to that at the very end. A couple last things we want to pull from the 10K. There also have a lot of information about options and shares. So I'm going to jump back over to 132. Okay, so there's usually there's this handy table of, you know, if there's other options that are currently outstanding. So do you have employee options outstanding? Yes, I do. Yeah. Basically so these are all the ones that have been forfeited. So it subtracts out what is netted out at the end is all the ones that are outstanding. So that is yes. Number of options outstanding. Basically it's this number here. Oh, one thing to note, I actually made this mistake earlier. So as they mentioned, all the share amounts are not, they're just like the actual numbers. So I needed to so this is actually 2.4 million. So I put this in as 2.48. I made a mistake at first and I actually put in like, I think 2489, like I've been doing for everything else, and I got a negative valuation, and yeah, that was obviously not correct. Cool. Okay, so I've got around 2.5 million options outstanding. Strike price, they tell you that. Average weighted strike price is around 103, so that's what I put in here. Average maturity is in around 5.5 years, which is also what I put in here. Standard deviation on stock price, this is on the page next. So that's expected volatility. That's the field you're looking for. So I put in 46.4 because this is a very volatile stock. Okay, so I believe that is everything. Actually, no, there's more. Okay, so we just did the share section. We're actually going to, before we get into the value drivers, we're gonna go and do the market number. So the risk-free rate, that's basically what is the price of the last 10-year bond. So it looks like today, it's been creeping up today. Okay, 1.57. That's what I have. Okay, cool. So risk-free rate, that looks good. Initial cost of capital. Okay, so if you don't know what that is, there's a special worksheet for that. We are going to jump to that now. And okay, so there's more stuff to enter in. Basically, when it comes to determining what your cost of capital is, there are a couple, actually, this would be a good time. Slides. Okay. As we call out here, there's a couple of different things we'll want to take into account when we're trying to calculate our cost of capital and the risks that come with that. So basically, risk and cost of capital are very much so correlated. So cost of capital, in other words, is basically how much money do you have to pay for people, how much money do you have to pay to investors of your company that will give you money to borrow or use. And so that basically, there's like usually two components to that, right? So capital is basically it is composed of equity. So that is, when you issue more stock, right, you're selling off parts of your company. And so that's one way that you can raise money. You can also raise money through debt. So, say that I don't want to sell off parts of my company, but, I will just like put out I'll put out like a bond or something so that, you know, I can borrow money and just pay interest on that. Preferred stock is, I guess, like I believe another just other version of equity. We're not using it here, so we're going to ignore that. But all of these combined make up all of your capital, right? And so the cost of your capital is basically a component of what is the cost of your equity and what is the cost of your debt. I feel like something's gone horribly wrong. This looks wrong. Okay. Oh, interest expense. I think it was supposed to be positive. I think that's why it's freaking out. Okay. But yeah, okay. So anyway, the reason why your risk level is very much so correlated with your cost of capital is because, of course, the riskier that you are, the more money you're going to have to pay for your cost of capital, because that's basically how it works, right? The riskier that you are, the more unlikely it is that people are going to make their money back. They're going to demand that they make more, I guess this is where the word like return or yield comes into play. They're going to demand that they get more yield back in return to compensate for the risk factor. So versus like if you're a really safe company, right? In that case, you know, that means your cost of capital is much lower because the chances that you'll get your money back are much more guaranteed. So anyway, I'm going to go ahead and fix this because I think this is why this is freaking out. Okay, so that's positive now. Yeah, okay, that makes sense. Just to sanity check this, your cost of debt should be much cheaper relative to your cost of equity. Because typically debt is usually much cheaper in general than equity. So that's something that you just want to sanity check for yourself. Okay, so as we talked about, operating risk, there's a couple of different things that we talked about, right, that will factor into the risk level for your company. It includes what businesses you operate in, so what industries are you in. In this case, we only work in software, so that's just one business. And also, what countries does your firm operate in? Because depending on where you operate, depending on where you actually make your money, that can also represent different levels of risk. And so equity, the relative risk, that's basically trying to capture the risk of the different industries. And we'll calculate that also for the industries that you're in and the countries that you're in. And then we'll also look at our debt metrics because, as I mentioned, I think the last video, the more debt that you have, it also represents a different level of risk because, for example, if you have a really high debt ratio and you have a lot of debt, that can inherently, and you have a lot of contractual commitments, right? Because you're obligated to generate a certain amount of cash or somehow get your hands on a certain number of cash to send out to your bondholders. That can also represent a certain amount of risk. So we'll just start from the very top of this and try to fill this out. Okay, so number of shares outstanding. This is automatically pulled in from the last sheet, as is the market price. So your approach for estimating beta. Beta is basically a sort of measure of the risk for your company. So there's a couple of different ways you can do it. If you can either calculate it yourself. I'm going to recommend let's not do that for now. And so your options are basically what kind of company is your company, right? Are you in a single business? Are you a global versus US business? Or alternatively, are you in potentially multiple businesses? Like, for example, if you're Amazon or something, and you're in a gazillion businesses, and different product lines, you maybe want to put multi-business. So in this case, I'm basically, it's one company. Yeah, it's basically one company, one industry. So I'm going to say single business. And that will, so you, in this box here, you'll want to put in what business you're in and what the revenues look like. In this case, this isn't a super good example because all of their industries are basically software. In a case, so I think in the sample case that Professor Damodaran uses, he's doing P&G, which is in multiple businesses. Does he have an example of this? Okay, yeah. Are we going to see it? Oh, God. Okay. Sorry, I don't have it queued up on my computer, but in that particular case, usually in the 5K themselves, they'll probably tell you, okay, we made, as we mentioned, right? If we look at, I believe it was 103. If they broke out their revenues by different areas. So in this case, these are all software, so it kind of falls up into the same. But if this was like a much more diverse company, they would probably break this out by the specific businesses that they're in, and you would basically try to map those product lines into a certain industry here. There's a certain drop down, depending what you want to put, and you'll put in the revenue associated with that particular product line. And so what this ultimately does, you get an ultimate number by breaking out what percentage of, so it's going to be weighted. So like, for example, if you've got, in this case, like, you know, 400 million and something and like 500 million something else, it'll weight the beta depending on the beta for each particular industry and then get you a final number. Hopefully, I guess, yeah, I'm thinking of doing Amazon next. So I'm guessing that one will probably be a bit more interesting on that front. So anyway, gives us a beta that we can use. The risk-free rate, that's what we grabbed from the last page. Risk-free rate, I guess I didn't call this out explicitly, but this is basically a measure of what is the rate of a investment that you can make that literally has no risk, right? There's no default risk at all. And so the approximate measure that we use is the 10-year treasury bond, which I guess you could say there's like maybe some like very small, like infinitesimal degree of risk, but for the most part, we're going to assume it's mostly risk-free. So that's what we'll use there. And okay, what approach do you want to use to input ERP? So ERP stands for Equity Risk Premium. And basically, this is the methodology that Professor Damodaran uses to help us calculate our cost of equity. So I believe the definition that he uses is, so it's basically cost of equity equals your risk-free rate plus your equity risk premium. Or rather, the equity risk premium, it's basically how much, so say that you have 1.57% as your risk-free rate. How much extra percentage do you need to pay in order to get someone to like give you equity money, right? In order for someone to actually buy your stock. I'm not doing it justice here. Professor Damodaran has so much material on risk premiums and stuff like that. And so we'll probably get into it maybe a little bit later and try and explain it in future videos. But for now, we're just going to go with that. And so, okay, there's a couple of different ways you can actually estimate this risk premium. You can do it based off of, so this is where I guess we're baking in all of our geographic risk, right? And so the way that he does that is he actually, so can I pull up I might have hidden it. So he actually has some good slides about how he calculates this, but basically he actually tries, he does this sort of like, I believe every single year or something, but what he does is for every single country, he gets the rating, so the bond rating for that particular country. And what he tries to do is use this as a proxy to actually figure out what the premium of how much more of a premium you have to pay to invest, or actually for that, what is the premium that this country needs to pay in order to get equity? And so there's a probably good video. I can try and link it in the description about how he does this. All of his, if you check his data, I might not search for it now, but if you search for his data updates every single year, he talks about like this and how he calculates it every year. So anyway, you can check that out offline, but for now, we're just going to go with operating country. So you can do it by country or by region. But so this, oh crap, did I save it? So this is where in the doc, they typically will tell you the breakdown of what regions that revenue was actually generated in. I don't believe I saved it. Did I save it somewhere else? Let me check. 67. No, it was not here. Okay, I'm going to do this. Okay, I have this very dumb thing. For some reason, I cannot actually search in my actual Australia. Okay, it is on page 20. For some reason, I cannot search directly in this doc because I somehow mangled it. So I have actually another doc I have to search. Anyway, regardless. Oh, actually, no, this is not the one I wanted. Is it on 21? Okay, no, it's not on 20. It's on 138. Okay. Okay, 138. It gives us revenue broken down by geographic location. So that is what we want. So US by far is pretty dominant. So anyway, type in Canada. Canada is shows up here as 192,000. I mapped that to 192. Do the same thing for all the other countries. So US, copy that over. UK, they also broke that out, copy that over. Australia, also copy that over. Everything else is like other, so it's just the rest of EMEA, the rest of APAC, and Latin America as these general groups. So what you can do is, you can kind of use both. So basically what you can do is, so what I did was I just mapped those categories into this spreadsheet, and I just broke out, okay, so like APAC was 170,000, so I put in 170 here under Asia. Do the same thing for all the other regions. So LATAM, I just mapped to Central and South America, and the rest of EMEA, I just put Western Europe. So China? Do I have China? No, I don't have China. It's just in here. So what that does is it will give me a certain total number, which I'll then pipe back into here. So rest of world, I basically just grouped up into one. So it was basically sums up to 160. And the ERP for it, I got from looking at the weighted ERP here, which is 5.987. So I type that in here. That basically then puts all the right weights in for everything, and it will give me a final ERP at the end of the day, 4.94. So that's what is used here. So in this case, like, I think, yeah, in general, I think what he generally says is that countries like developed countries like the US, like like Australia, I guess as well, like Canada, are generally seen as like AAA, like really top rated countries. There's like, it's generally much safer relative to everything else. And so by default, that's sort of the baseline you compare it to. So by relatively speaking, then when you think about it, 4.94 is actually quite good, right? It's only slightly above the sort of baseline rate that we're looking at, which is 4.72. And that's because, right, as you can see, the majority of the regions and the places that Shopify gets their revenue from are all like developed countries. So it's generally not as risky. Okay, so we've calculated our cost of equity, I believe. Oh, actually, so as you can see here, if we check and just confirm, the equity, the cost of this particular component is B12. So B12 is the risk-free rate times I believe it's the equity 45. 45 is levered beta for equity times 15, which is equity premium. Why does the levered beta, Actually, so I'm actually not quite sure why we use the levered beta here, but at the high level, basically what we're doing is we're taking this equity risk premium, we're adding it to our risk-free rate. There's some stuff with this beta thing that I need to look into, but in general, that will give us the cost of equity, right? In this case, which is around 6%. Okay, so, okay, cool. So that is cost of equity. That we've got 1/2 of our equation, and now we need the cost of debt. And so book value of straight debt. Oof. This is actually, this is something I need to look into because I'm actually not quite sure in this case. Should we use the 912 number that we've seen here, or do I actually want the 103? Or do I actually want just this 758 value? Okay. I will need to, actually, no, it looks like it just grabs it. It just grabs it from the other one. Okay, so I guess we'll just grab that. Average maturity, in this case, their main source of debt is, I believe, their convertible notes, which I believe expire in 5 years. Let me see if I can find that in my thing. Yeah, so if you look at page 6, it says, is it actually? Why can I not see it? Oh, okay, yeah, it says here. 2020 offering of these convertible notes due in 2025. Okay, actually, I should say 4. Okay, so average maturity, I'm just going to guess it's 4 because the current bit of debt they have expires in 4 years. Okay, approach for estimating the pre-tax cost of debt. So you've got a couple of different options here. Like for example, I think if you're lucky and this company that you're evaluating actually has like a bond out there on the market, I believe what you could do is just take the percent yields, I believe, from that, which is when you would do direct input. In this case, I don't have something I can just check against. So there's two different ways you can estimate it. Actually, no, sorry. That's what I meant with actual rating. So if this company actually has a rating out there on the market, like for example, if they, are an established company, they have a rating because they have a lot of bonds out, you can just use the rating itself. So in that case, you would put the actual rating that they have. In this case, Shopify does not have a rating, so I used a synthetic rating. So he makes a note here. So basically he tries to approximate this by looking at some of these stats. So looking at this, you want to put in 1 if it's large market cap over 5 billion. That is definitely the case for Shopify and safe. Or you want, or actually, maybe I should put 2 because it is kind of volatile. I mean, it's kind of risky. Maybe I'll put 2. Okay. Or 2 if it's riskier, you want to put 2. Maybe let's just put 2 and see what happens. Oof. Okay. So it looks like everything's going to go up. Okay. So just to kind of sanity check that, this sheet, you don't need to, this should all just calculate by itself. But this is the sheet where he calculates what your cost of debt is. And what he does is he basically tries to take into account what is your operating income, how much are you paying on interest, take into account the interest rate. And he basically tries to actually back out a bond rating. So if you don't have a bond rating yourself, he tries to back that out for you based off of what your interest coverage is. So interest coverage is, I believe it is the total assets over your interest expense or something like that. Basically, it tries to track how much more do you earn relative to how much you have to pay in interest to get a sense of how safe you are, right? So if you have like a really low interest ratio, that's really scary, right? Because that means, so basically if you have an interest coverage ratio of 1, that means you make just enough, I believe, to cover your interest payments, which is scary because that means you spend all of your money on interest payments. So as you can see, right, depending on what your interest ratio is, if it is like 1 or below, it's a really bad rating, right? So that means you're in the B, C category. And then if it's much higher, then you're much safer. So in this case, they have an interest coverage ratio of around 10, which would put it in this like second tier category. So tries to back out a bond rating for you given your interest coverage ratio, and then it backs out a cost of debt. So, okay, so that from all that calculation, it gives us to where we are here, and it also gives us the tax rate. Book value of convertible debt, as we called out, right? So we have, go back to 102. We have these convertible notes here. So I believe notes just sort of is another word for debt. So it's around 758, as we called out. So that's what I typed in here. Interest expense on that convertible, I believe, is just that 9,000 we saw here. So that's why I put in here. Maturity of the convertible bond is 5 here, which is what I put. Market value. Oh, I'm not quite sure how this is factored in, but I wasn't quite sure how to include it, so I just left it blank for now. Yeah, how would you calculate this? I'm not quite sure. If anyone knows, let me know down below, and I'll incorporate this for the next time. But in the meantime, we're gonna skip over that. And then preferred stock, they don't have any preferred stock, so I just left that blank as well. So that gives me how much? Yeah, so we said nothing there. Okay, cool. So ultimately this ends up, it gives us all the inputs here. So it gives us how much is your equity worth, which we saw on the last page, how much is your debt worth, how much, across all of your pools of capital are you using debt versus equity. In this case, it makes sense. Shopify is still a pretty early on company, so they're not using very much debt yet. And so it's mostly weighted towards equity. And then we have the cost of equity for both. And that ultimately lends us with the ultimate answer we were trying to get to, which is the cost of capital, which is currently around 6% for Shopify. So cool. Okay, so that brings us back to, yes, that's how we got that after that really long detour. And okay, In the home stretch, last we have the value drivers. So this is where you're gonna put, you're kind of going out from just punching in numbers, and this is where you kind of have to do some critical thinking to think about, right, what you think is going to happen for this company in the future. There's some data here that you can use, both looking at historical data, both looking at like industry data, just to kind of get a sense. But this is where this is ultimately up to your interpretation and your opinion about what the direction for this company is going to go. So first up, you want to estimate the revenue growth for your next year. So here's how my thought process was and the numbers that I came up with. I came up with 70%. And the reason why I came up with that was, so their last year, they grew by 70%. Something to think about. So I guess this is where you have to start thinking about like what company, what area is your company in? What is the position of your company in the industry that they're in? And where do you see that going in the future? So last year was a really good year for Shopify, right? Like, of course, everything shut down, everything turned a lot more towards online, and Shopify was one of the really key beneficiaries of the big shift towards like, e-commerce, because, a lot more people started selling online, a lot more people started setting up shops. So 70% is actually pretty aggressive already. And it's very much so sort of assuming that we're going to continue to kind of keep that going in the future. Another thing you can do to help you come up with that number is just comparing it to, look at the annual numbers, comparing it to what has happened before, right? So if you look at it, our revenue percentage numbers, so of course, when you're smaller, it's much easier for these numbers to be higher because you're working off a really small base. As you get larger, those numbers will start to tail off, right? But so it looks like in the past, right? Shopify has been public for, I think actually was public in 2015. So I think all this data is actually incorrect. I don't know why this is here. But okay, looking at everything forward, so it looks like revenue growth, was really high. It was like over 100%, has slowly been tapering down over the last couple of years. So it looks like we went from 60% to 66%. So it looks like it's accelerated a little bit. And in general, I think I'm going to assume that is going to continue to be the case, right? I think Shopify is still, my general take is that Shopify is still hitting its stride, right? It's still in this really big growth stage where they're still getting a lot of merchants. They're still getting a lot of revenue. Actually, so another thing this is another place where you can kind of like think a little bit more critically. So I took all these notes about just trying to better understand Shopify's business. So I tried to look at like industry metrics for e-commerce and what people estimate to be the size of the industry. Tried to also grab some information about competitors to try and like, get a sense of what the landscape looked like. And another thing I did was also try to look at the lines of business. So as we mentioned, right, Shopify has two different areas that they get revenue from. They get money from subscription solutions. So that's basically all the reoccurring money that they get and recurring revenue they get from merchants subscribing to Shopify and using its software. So they make, I believe the basic plan's like $40 a month or something. And so that's all, in addition to that, it's basically all the reoccurring money that comes from people just like subscribing to pay for the software itself. And then separately, they have this other area called merchant solutions. And so actually, so I try to break down what that means specifically, because they have another item later on in the doc that spells out like what is actually included in these different categories. So in subscription solutions, as we mentioned, it's the software, right, that you're paying for. They also have a POS system for like online or in-person brick and mortar retailers. So people pay a subscription for that. Also includes things like themes, apps, stuff like that. Outside of that, merchant solutions. So this is where Shopify has created all these like very new different lines of business, right? To provide additional services to merchants that are on their platform. So they have a payments gateway that they help people process money and transactions through. They've got this like lending program called Shopify Capital where they lend money to merchants. They've got things like advertising on their app store. They have also this new product called they have these installed payments solutions. So for people who want to actually pay for something in chunks, they get money through that because I'm guessing they make interest income off of that. Shopify shipping. So they have this like special integration with these different shipping providers. So they have layer that they make profit off of from that. They've got SFN is Shopify Fulfillment Network. So this is their third-party fulfillment network that they're using to help merchants actually fulfill their orders, etc., etc. One thing, I guess the reason why I call that out is one thing that I saw is that I have to look for this launched page 23. Okay, so one thing that I noted was they were very clear about, okay, these are when all these different initiatives launched, right? So Capital was launched in 2016. They're only currently in the UK and in Canada. They launched Shopify Email in 2019. Actually, I think there's like a more detailed breakdown further down, because they actually break it down at some point by like, this is what was launched in each quarter. Let me see. Okay, yeah, 2031. So they actually track down like, okay, by each quarter, this is what they launched when. And generally, I bring all this up to say that a lot of these different new initiatives that they've called out are initiatives they have just launched. And so my general assumption is that, okay, if they've just launched this, there is, I'm guessing that, it's not super penetrated yet. There's still a lot more adoption they could get. And so with that, because also as you see, right, this I believe is... Yeah, this is last year. This is this year. This is basically tracking what is the percentage of revenue from each source. And as you can see, subscription solutions used to be 36%. It's now 28%. And so that means subscription solutions is going down as a percentage of revenue and merchant solutions is going up, which means that they're starting to get a lot more money from all these like side initiatives that they have. And so my general assumption is that a lot of these are still very early on in the cycle. And so I think there's still a lot more growth that can come from it. All this to say that that's what I'm using to help me back up my 70% revenue growth number here. So that's what I'm going to assume for that. Operating margins. This one I was a bit conflicted about. So right now it's actually very low margins, right? Sort of unsurprising because actually I think if you compare this to Amazon, I believe they also have really low margins. My thing is not cooperating right now, so I'm just going to manually type that in. Okay, so if you look at Amazon's margins, right? Amazon's margins are really low. So it was fairly low. It's like single digits. And then it kind of like, it's peaked at, I guess at some point up to 5% and then it fell back down again. And looks like it's kind of creeping up now, but in general, right? Like I'm using Amazon because in some ways it's kind of sort of similar. It's like a quite similar party that you can use to to actually, have things to compare against, because Amazon is, has been in the e-commerce business for a long time. They also are kind of similar in some ways to, there's a lot more that's going on, of course, with Amazon, but similarly, in addition to Shopify, they also are, have, of course, invested a lot in like physical fulfillment centers and stuff like that, which is the direction that Shopify is going in. So I basically kept it fairly low. So actually, if you look at the industry, right, the margins that they have are much higher, right? It's closer to like 20%. No. So this is just for next year. So next year, I'm assuming nothing major is going to change. They're going to continue investing a lot in all the things that they have been investing. So I don't imagine this is going to change much. That's why I put 3% here. This is where, okay, so this is just a metric for next year. Then after that, you are trying to actually calculate what that's going to be even further out than next year. So what is the revenue growth rate going to be in years 2 to 5? And so in this case, I assume that, especially because you start to see for revenue growth, like if you look at Shopify, they have been sort of leveling out, right? As we talked about, like, okay, it was really high. And then over time, like it was 60 last year, 70, close to 70 last year. I'm assuming next year it'll still be 70, it'll be pretty high, but I'm going to assume that over time it's going to start dropping off, right? And so this might be, so I put 50%. And so this, in some ways you could argue and say maybe like, it basically is your assumption around like how fast do you think that will drop off? Like, do you think it's going to continue to stay that pace or do you think it's going to slow down? I guess I was a little bit conservative here, and I was like assuming, okay, I think it's gonna be strong for like a little while longer, but I think over time it's gonna decrease. And so I put 50% here. I might actually type in 60% because I do think it is still gonna be quite elevated for a little while longer, and see how that changes the valuation. But for now, we'll leave 50%. So yeah, actually, okay. One last data point. Let's see if we look at Amazon. What does theirs look like? To be fair, Amazon is not a great example because they've got so many other businesses. But okay, revenue growth, like they've been a big company for a really long time, and it's kind of impressive because they've basically had, like as you can see, their growth has been ranges between like mid-20s it seems to like low 40. So it's like 20 something to like high 30s. And so, okay, so I mean, looks like they've been able to maintain that for quite some time, but of course it's like 30%, right? Which is insane. Also talking about the numbers that they're looking at. But yeah, in general, okay, I'm going to stick with 650 for now and see how that goes. And then, okay, margins. I was talking about this earlier. So as I was talking about, we have really low margins right now, right? And that kind of makes sense because they're investing a lot, they're reinvesting a lot in, they're spending a lot of money in R&D, in, sales and marketing, and they're really much so trying to build up their business right now, especially with some of these like really capital intensive businesses like SFN, where you're actually building out and working with like, physical actual like fulfillment centers and stuff. And so in general, like it looks like the operating margin for the industry in general is much higher, right? It's closer to like high 20, like around 20% ish. That makes sense, right? Because software as an industry, typically I would imagine has pretty high margins, especially because like you are not like, you don't have a lot of like capital, like, commitments usually that you need to do. And so in general, I guess I took both of these things into account. So I didn't set it at 20%, but instead I lowered it down to around 15%, assuming that, okay, you're going to have, because like this is where I'm like thinking about Shopify and looking at the split of business, right? So mostly it is a software company, but they do have some, like things that will ultimately drag their operating margin a little bit further down. So okay, for example, like one area is, as I mentioned, actually, so I put these things here. So Shopify Payments, right, is their payments sort of solution and gateway. And that is actually built on top of another company called Stripe, right, who provides a lot of the sort of like financial rails. So that is, for example, a fixed sort of percentage they'll always have to pay out to Stripe. So as Shopify Payments grows, they're also going to pay a percentage of that to Stripe, which will affect margins. And also all the stuff they're doing around, as I mentioned, fulfillment and working in like hardware and stuff like that will also, I imagine, bring that down. So it's not just a pure play software business. So that's why I put 15% here. So it will definitely, I imagine it will go up from where it is now, but it will probably not be, I imagine it might not be, exactly the same as a pure play like software business. Okay, sorry, I'm being very long-winded here. So that's 15%. Year of convergence. So this is basically saying, okay, so I've like mapped out where I think it's going to go in the future, right? So I've mapped out, okay, I think like this is what margins will be in 10 years, and stuff like that. And convergence basically means how fast will I get to this particular point, right? So if I think that they're going to get to 50% margins really fast, I would say like, maybe like something under 5, right? So like under 5 years, I think we're going to get there, versus if I think it's going to take us a while to build up to that, I think it's going to take us 10 years to get to 50% margins. That's what I would put here. So yeah, this is the forecast year in which your current margin will converge on the target. So I think it's going to take the full time to get to that level because we're pretty far away from that now, right? We're at 3%. Okay, so I think we're ready. Okay, last, this is an auto-calculated thing. Sales to capital is yet another a metric that we want to track because this basically tells us, so as we talked about way back when, right? There's this line item here. So how much of the growth that we're getting, right? So of the 50 to 70% growth that's coming in, we want to also understand how efficiently are we actually getting that growth, right? How much money do we actually, so this is what captures that efficiency of that growth, because this is basically saying for all the money that I spend, right, to plug back into my company, how much do I actually get, like how many units of sales do I get for every like dollar of capital that I put in? And so in general, you want this to be as high as possible, right? Because the higher it is, that means that you're making more sales and more revenue for every unit of capital that you put in. And so it looks like, it all calculated this for us. It looks like we're at 3.16. If we compare it, it looks like it's actually quite good, right? I mean, at least compared to our industry standards, which is closer to 1, right? 1, which means basically for every dollar of capital you put in, you actually get like slightly, that's actually kind of bad. But you actually get slightly less than that back in sales. So yeah. Anyway. Okay, so that's that. So, okay, I think we're ready. I think we're ready to actually look at the output. So this is what it looks like. It basically plays out for you, okay, for the next 10 years, and then in the terminal year, how is that actually going to play out? And so, like, as I mentioned, right, what I mentioned was, okay, in next year, I think it's going to be 70% growth. And then in years 2 to 5, I think it's going to be 50% growth. So it factors that in. This is where I guess a good point to call out that, I'll probably talk about like terminal value maybe in another video because it's already getting kind of long. But in general, this is, I guess, one of the key assumptions that you can update. There is an assumption here that, which one is it? Okay, this one here. I will assume that the growth rate in perpetuity is equal to the risk-free rate. Okay, so it's a combination of both of these actually. So, okay. So this is a good time to talk about assumptions. So one thing that he does is you have a current risk-free rate right now, as we called out, right? It is 1.57, and the risk-free rate is very important in the future as well. And you'll see that for a couple of reasons. So, you can either assume that the default assumption is that he's going to take your risk-free rate now and just like use that as the risk-free rate in the future. You can decide to override that though. So that's what I did here. So I said, yes, I want to override that and I want to make it 2% because I think, let's say for now, I think that the interest rate is actually quite low and is not what it's going to be in the future on average. So that's what I put in here. I put in 2% risk-free rate, and that compounds here to, okay, what he does is he assumes that your growth rate in perpetuity is equal to the risk-free rate. There are there's this whole academic reason for why he assumes that. I might go into another video, but for now, we're just going to go with it. In this case, I assume that I'm going to take that assumption and I'm going to assume that is the case. That's why over time you see this going from 50% from years 2 to 5 gets somehow down to 2% over time, because I use 2% as my risk-free rate. In some cases, I don't know. I feel like in this case for Shopify, this feels probably overly aggressive to me. Like for example, I'm using Amazon as a comparison. So Amazon actually, right, it's had significant growth above the risk-free rate for many years. Of course, they've proven that, they can go into new businesses and get revenue and all this stuff. So that's not necessarily the assumption for Shopify, but I do think 2% in 10 years is maybe it's a bit pessimistic, but anyway, I'll just go with that for now and kind of go with it. So anyway, it will populate out, okay, here's what your growth rate looks like. Here is what that actually means as far as revenue goes. So I'll actually multiply that out. This means that in 10 years time, so Shopify now, as we looked, right, it's currently making around $3 billion. And I'm basically saying in 10 years, I think it's going to become $65 billion. That's crazy. This is where you'll want to sanity check this, right? And actually check this against, okay, what do all the other companies in this area look like? And, you want to sanity check this to see if this actually sounds feasible or if it's a bit pie in the sky. You also will want to compare this to the overall market size, right? For example, if your revenue here is greater than the actual market size I mean, there could be arguments for why that actually could be the case, but you'll want to just sanity check this to make sure that that seems valid. In this case, Amazon is, not a super amazing model, because Amazon is like in so many other businesses, but Amazon, I guess, as you can see, is, there is probably a way that, okay, let me see if I can try and figure this out on the fly. Okay, so one way you can think about it is Shopify Gmv. So Gmv is basically all the total value of the transactions going through Shopify, right? So last year they announced that it was $120 billion. So Amazon, right, has a separate, similar parallel business called Fulfilled by Amazon. It's basically the third party like business. They also, I think someone also, I think I looked at this article that tried to approximate what Amazon's like marketplace business does. Okay, so it said, okay, so this is what I wanted. So looking back a bit, they had this much GMV in 2017. So 3 years, Shopify is 3 years behind. One maybe cheapskate way I can do it is say, okay, last year they made, this is probably a bad proxy, but one thing you could kind of do, I mean, okay, I probably have to look a bit more into Amazon's like statements to kind of try and sanity check this. One thing you could do is kind of look at, okay, 3 years ago, what was their revenue, and try to use that to kind of sanity check. And so I'm not gonna do that now, but that is something you can kind of take into account in trying to sanity check this number to see if $65 billion makes sense. So I might follow up on that because I think I'm gonna do Amazon next, and we'll see. I'll try and dig this up and see if I can get an answer to that. Okay, next up, as you can see, it tries to play out, okay, what does margins look like? So as I said, I think it's going to go from 3% next year all the way up to 50%. So it's going to calculate out, okay, what is your operating margin going to be, assuming you also make this much revenue? So that means I think in, 10 years, I'm going to be making around $10 billion in operating income. That is, of course, a far cry from where we are now, where we are at, our operating income is it's $90 million. So that's many folds over what it is now. I can't do the math off the top of my head. And it does the same thing for all the other things we talked about, right? So tax rates, your investment, et cetera. It tries to calculate your free cash flow based off of that as well. Oh, NOLs. Okay. This is another thing that I could not figure out actually. So NOLs stands for net operating losses. There's an assumption about this. Where is it? Here. Okay. So one thing that ideally you want to factor in is, so for example, if you're a money losing company, right? So let's go back to shop. If you've been losing money for a while, you actually get a tax benefit because you get to sum up like all the money you've actually, I don't have it here because I don't have operating income. Is it net income or operating income? I don't quite remember. I think it's operating losses, right? Okay, yeah. So I don't have operating income on here. Actually, let me try and pull it up on my other. So let's try and pull that up. This is my cheat. When I don't have the data on my spreadsheet, I just use this to check. Okay, so we're gonna look at shop. And then we're gonna look at their income statement. Okay, so if you look at their operating income, this is what we wanted. Okay, so, let's look at, annual. So, okay, from the last couple years, they have been losing money for the last couple years. Their operating income has been negative, right? So one tax benefit you actually get is if you've been losing money as a company, you get to actually save that up as a credit somehow, so that when you start making money, you get to actually deduct out all those years that you lost money, and you can actually postpone having to pay taxes. And so that's the general idea behind a net operating loss. Unfortunately, I tried looking it up, and the way to actually calculate what the NOL is actually quite complicated. And I tried to look it up and I could not figure it out. Yeah, so I think I found some notes around like you can kind of try to approximate some of this. But anyway, I need to figure out how to look it up. In the meantime, I know that there probably is some net operating loss that they need to factor in. I just don't know how to calculate that. I guess maybe I can try and approximate this badly. Let's just say 25 plus 50 plus 62 plus 125 plus 151 minus, let's say 221, because they used up some of it. So, okay, let's maybe approximate this and say it's 192. Okay, so let's just say 192. We're going to guess million. Okay. Okay, so as you can see, that means that it'll kind of factor out and include some NOLs for that we want to include to help what's the word? We want to sort of offset the cost of our taxes for the next couple of years. And so that's what NOL is. And then as we mentioned, here's cost of capital. It will change, of course, also as your interest rate changes. Because of course, as we mentioned, the risk-free rate is part of your cost of capital. And all this to say, I'm going to skip over some of these interim steps, but we'll probably talk about like the terminal value stuff later. But okay, starting from up here. Oh, okay, actually another assumption. So one other thing that you probably want to do is, so he makes an automatic assumption that your firm has no chance of failure over the foreseeable future. In general, that is probably an unlikely statement. So I think one thing he calls out is that even if you're a very established company, there probably is some degree of chance of failure, right? Because like, for example, you could say like, actually a good example is like car companies, right? So like GM and Ford. So actually, no, actually, so like maybe in the 2008 crisis, right? In the US financial crisis, like the car companies were having a super bad time, right? They had, I believe, like all this debt that they were having a hard time repaying and whatnot. And so that, I guess I'm pointing this out just to say that even if you're a very established company, there is still a chance that you could go under because of maybe some random like extenuating circumstance, right? So you could say that the travel companies or the hotel companies last year were kind of in a similar case. Oh, actually, good example from a recent case, airlines. So airlines, there's been a lot of chatter over the past year or so around like, they're hemorrhaging money because they've got all of these assets they can't really use. They've got all these fixed costs. And so like last year, even though before COVID, you would have said, okay, they're a pretty strong company. When something like COVID happens, it's an extenuating circumstance, there's still a chance that you could fail. So anyway, I do decide to override this assumption and I just build in, so I build in 10% probability of failure, which could, I don't know, it's hard to estimate. I think he calls out that there's a couple of papers you could call out. Actually, let's look at these really quickly. I believe in some of these, he has actually like okay, I don't have it listed here, but in some of his slides, he actually calls out the failure rate of companies. And so you could probably look at that chart and figure out like where you want to put it. In this case, 10% could be a bit optimistic, but in general, I don't know. I think I feel pretty good because, Shopify is in a really hot space. E-commerce is, it seems like it's in the right area right now. And I think that in general, they've got a lot of cash that they're sitting on right now. So they have some buffer. And on top of that, I think, with the markets the way they are right now, I think they have a lot of access to capital. So I think the chances that they'll fail is more unlikely. And then if you want, you can also say, you can also mention in the case that your company fails, right? What is your company worth? So like how much is it potentially going to be worth? In this case, I just said 50%, I think just as just like a guess. So anyway, that's what's factored in here. I said 10%. It gets factored in here as 10%. And what that means is that they'll actually take off, I believe you will multiply the actual valuation by the odds that you might, by the odds that you will succeed. So in this case, it'd be 90%. So it shaves off a little bit of your valuation. And so, okay, so yeah, basically you've got your value of operating assets. It subtracts out all those items that we mentioned, right? So it subtracts out the fact that you have all this debt that you currently have to repay back. It adds back the cash position that you have. So they have around $6 billion or $6.4 billion. It adds back the minority holdings that it has. So as we mentioned, there's the small holding it has in a firm and some of these other companies. So that is added back here, which gives you a value of equity of around $64 billion. You subtract out the fact that, you've got all these different options that could get redeemed out, which leads you to this number here, which is basically what we think the market cap of this, what the valuation of Shopify is and what we think the valuation is. And so it looks like, from all the assumptions that I've made at least, I think that it's worth around $62.5 billion. And so if we divide that out by the number of shares that's outstanding, that gives us a estimated price of $560. And as you can see right now, the price is basically double that. And so you can, so this is at this particular point where you kind of you can look at that and you can say, there's a lot of things you could do to sanity check that and make sure that it looks, you can just sanity check that and make sure it looks kind of kosher, that you didn't kind of blow something out. In some cases, I could say I could kind of buy this because right now I will say that the markets are extremely heated, right? Like there's a lot, like tech has been super, super hot. Maybe this past week, maybe not so much, but tech has been really hot. And so I kind of could believe that, you know, the current price of it is way over what it's actually valued at. Another way we can kind of sanity check this is if you look at the multiples, this is where, oh, actually, no, I can check, you can use another thing, but, like if you go back to this is where you can use our industry comparison. So, another way you can kind of sanity check this is, okay, we're looking at Shop. This is where, these are my, percentile numbers for a given industry, right? So this is, all these numbers on the side here basically say, given for this, all the companies in the software industry, what is for all these different financial metrics, what is the 75th percentile, median, 25th percentile? So one thing we can actually sanity check is actually, we can look at these multipliers and kind of get a sense of, okay, like how much of a premium are people paying for each dollar of sales, each dollar of earnings, and look at this. Okay, so it looks like their price to sales ratio is 140 relative to all the other ones in the industry, which is much, much, much below that. Same as for earnings, right? This is even more insane. So it's basically like 10 times more than even your 75th percentile for PE. And so on and so forth. And so I think, like, I guess I'm just pointing this out to say that, like, okay, you know, I'm getting a valuation that is like basically half what the current price is. And looking at these numbers, I can kind of see that because, like, if you look at these multipliers, they're insane, right? They're like much higher than some of its peers in its peer group. So I can kind of buy the fact that it actually is that overvalued. Another thing is he calls out is that you could actually look at the return on invested capital, which looks like we would average out around 35% in year 10, and you can compare that with your industry comparison. So return on invested capital looks like it was at 35%. Okay, so maybe, so it looks like the return on invested capital right now is much lower than that. And so maybe that is a sign that, like, okay, something looks a little off here. If it is high too low, you may want to lower your sales to capital ratio. Okay, so this is where, yeah, you can do a bunch of debugging on your own to kind of figure out and sanity check to see if you think this makes sense. Another sheet he has here is, he looks, oh, I thought B9, where's B9? Price. Wait, why does this not? Interesting. Why is this not calculating? So basically, this used to calculate it. Not quite sure why it's not showing up right now. Oh, wait, no. Okay. Anyway, basically, it has this formula that should, theoretically, if it's usually working, say that one thing he calls out is, okay, if your value as a percentage of your current price, in this case, I have like 50%, so I'm basically saying my valuation is half the price of the actual price. It would tell you if it's less, high. Wait, no. Anyway, it would basically try and tell you, okay, if your value looks potentially too high or too low, and it tells you here are different things you can do to try and maybe tinker with the numbers and see if that actually makes a bit more sense. So in this case, there's a couple like, I don't know. I think it really is up to sort of your interpretation and what you think makes sense or not. You can, yeah, of course, like, as you mentioned, like, yeah, because if you look at it, right, your sales to capital ratio, as we called out, is like much higher relative to the average. So maybe you could say that's unrealistic. Like maybe I don't think they're actually going to be that efficient, and maybe that should be overridden, in which case you would do, wait, where was I? This one. You could try and update this and maybe say like, maybe I think 3 is too high, and you could say maybe I should update this to 2. Does all of this? So I could say like 2. How much does that actually update anything? It goes down. It goes down? Anyway, interesting. I've not toyed this myself, so I'm not actually quite sure. But yeah, as you mentioned, like there's a couple of different levers if you look at this diagnostic sheet on the bottom here. There's a lot of different levers you could tweak to see, to finagle your numbers and see if maybe you want to re-question some of your assumptions. So like, cause like, for example, maybe 50% I think is too high. Maybe it should actually be like 40%, or maybe I actually think maybe it'll actually keep up, and maybe it will stay like, you know, at around that for a while. And so, yeah, so basically that's it, right? We punched in all our numbers. We got a total like market cap for it. We got an estimated price, and depending on how much you believe in your numbers, right? This is where you kind of would use this to help you figure out how you want to think about Shopify. Maybe you like still believe in it and you believe in the e-commerce story. Maybe you run these numbers and you're like, actually, okay. This is another point to mention. Oh, I don't think I have this pulled up right now. But another thing that Professor Damodaran does is he actually will calculate out, oh, I really want to find it, but I don't think I have it on hand right now. Let me see if I have it saved somewhere. So basically one thing that he does is, okay, I don't have it saved. He actually, when he does his valuation, he will actually does he do it in this one? No, he does not. Crap. One thing that he does is he will actually create like a matrix and say, okay, here are all of the different, like he'll basically call out all these different scenarios of he'll call out like, okay, so on one side he'll maybe put like, okay, here are the different potential operating margins, right? Maybe it goes from like 5% to 8% to like 10% to like 50%, which is the one I put. And he'll also put like different variations for revenue growth. So maybe he'll say 50%, which is what I maybe let's go lower. So let's say maybe 25% or 30%, 40%, 50%, 60% for revenue growth specifically. And what he'll do is he'll actually calculate out like the whether it's the market cap or the share price for this company given all these different assumptions, and that basically will give you a range, right, of what a company could potentially be worth. And another way you could actually look at that data is by saying, you can kind of look at it backward by saying, okay, given the current price, right, like what are the certain, you can use this matrix to help you figure out what are the certain conditions that the market is assuming that will be the case in order to actually get this valuation, right? And you can work backward to figure out, okay, what is the margin that this valuation and this price is assuming? What is the revenue growth that this is assuming? And you can see if that actually makes sense, right? And if it seems outlandish to you and you don't think it's realistic, then that's probably a sign that like, okay, I think this thing is overvalued. I'm going to stay away. Versus like maybe if it's really aggressive, right, and it's actually quite low relative to what you think it's going to be, then, you know, you could also see that as a case for you to actually buy in. So I'm going to try and dig that up and show that next time we do another one, actually maybe in my next video, so we can kind of just close the loop on that. But yeah, I hope this is getting really long, but I hope this was helpful. I know this is a bit rambly at parts. But yeah, this is sort of a bunch of it in a nutshell. We'll go through this again with another company and just get more practice at this. And yeah, I hope this is helpful, and happy valuating. I don't know, is that a word? Valuations? Happy valuations? Yeah. Okay, bye.